Good morning, hunters, and welcome back to the Daily Hunt for Multi-Baggers. It's Monday, March 16th, 2026, and we've got a fresh batch of market commentary from data analyzed yesterday.
That's right, Ethan. We saw a moderate number of discussions emerge across a few different symbols, giving us some interesting insights. The overall market sentiment, I'd say, is a mix today. Some very bullish community plays alongside some serious fundamental red flags. It's certainly a day for careful analysis.
All right, let's jump right into it then. First up, Hims and Hers, ticker HIMS. Brooke, the community is absolutely buzzing about this one, you know? We saw a post titled, "Hims to the Moon. I am the guy who YOLO'd his life savings on this stock 2 weeks ago." Talk about conviction. There's a lot of talk about an extremely low PE and a high short interest of 40 to 46%, potentially fueling a massive short squeeze towards 40. Plus, we've had recent news of a new deal that sent Hims soaring and analyst optimism. This stock, it's been rated as a buy or cautious buy quite a few times recently. It feels like there's significant growth potential here.
Ethan, I appreciate the enthusiasm, I really do, but we need to look at the numbers. While the community sentiment is certainly strong, and yes, the insider buying is a powerful signal, over 43% of net shares purchased in the last 6 months, some of the core claims are, well, let's just say contradicted by the data. The extremely low PE mentioned, our KPIs show a PE of 48.56. That's considered quite high, suggesting a lot of future growth is already priced in. And the debt-to-equity ratio is very high at 207.16. That indicates substantial financial leverage and risk. While revenue growth is decent at 28.4%, that debt and high valuation, especially with a beta of 2.6, make it incredibly volatile. For most investors, despite the new deal and insider confidence, the current financial risk is significant.
So even with all that to-the-moon energy and insider action?
For Hims, our AI-generated insights suggest for most investors, it's a stay away for now. The high valuation and debt load present substantial risks, despite the strong insider confidence and recent positive news. It's a high-stakes play.
Okay, fair enough. Next, we have Nordic American Tankers, NAT. This one came up with a thesis linking it to the Strait of Hormuz escalation, suggesting higher tanker rates could be a big win for them. Jim Cramer even mentioned playing with the house's money on NAT, which always gets people talking. It feels like a company that could really capitalize on current global events.
Well, Ethan, while the geopolitical thesis for the tanker industry might have merit, the social media discussion around NAT specifically was quite bearish. The most upvoted comment directly challenged the idea, pointing out that several of NAT's tankers might actually be trapped in the Persian Gulf, making it impossible for them to benefit from higher rates. Beyond that, our KPIs for NAT are quite concerning. The PE ratio stands at an astronomical 83.67, implying massive overvaluation. Revenue growth is negative at negative 0.656%, and the net profit margin is a thin 6.7%. Add to that a high debt-to-equity of 95.20, and you've got a company with significant fundamental weaknesses that might not even be able to benefit from the very catalyst being discussed. This stock has never received a positive rating from our AI before, and these numbers don't improve that outlook.
So the big picture macro thesis might be there, but NAT itself might not be the right vehicle?
Precisely. Our analysis for NAT points to a definitive stay away. The fundamental weaknesses combined with specific operational concerns voiced by users make it too risky.
All right, moving on to WTI Offshore, WTI. Now this one's interesting, Brooke. We didn't see user discussions directly about WTI today, but the analysis flagged it. There are massive tailwinds in the oil and gas sector right now. Oil futures soaring, escalating tensions in the Middle East pushing crude prices over $100 a barrel. Investment banks are raising price targets for big players, and WTI has seen a significant jump from its 52-week low. Plus, there's been some insider buying, over 286,000 net shares purchased in the last 6 months. It feels like it could be a turnaround story, catching the wave of the market.
I see the allure of a sector-wide tailwind, Ethan, and the insider buying is a powerful signal, no doubt. However, we have to look at WTI's current financial health. The numbers are frankly quite dire. We're looking at a negative net profit margin of nearly negative 30%, a negative earnings per share of negative 0.99, and a deeply negative price-to-book ratio of negative 2.5. This indicates that the company's liabilities exceed its assets, a serious red flag. While higher oil prices could eventually improve these metrics, the company is currently not profitable and in a precarious financial position. Relying purely on external factors without fundamental improvement is a highly speculative bet. Our previous rating for WTI was stay away. So even with the insiders buying and oil prices going parabolic, it's still too much of a gamble? For WTI, our analysis indicates stay away. The severe underlying financial weaknesses outweigh the speculative potential from rising oil prices and insider confidence at this time. It needs to show tangible improvement in its profitability and balance sheet.
Okay, let's wrap up our stock discussions with Micron Technology, MU. This one has a lot of attention with earnings coming up on March 18th. The community is questioning whether it's a breakout or rug pull after a significant run. But beneath that, the core thesis is strong. The memory cycle is heating up with huge AI demand, data center expansion, and tightening supply. Our data even shows Micron is strategically expanding in Taiwan to meet AI DRAM growth. Plus, MU has a strong history of positive ratings from our AI, including a buy just a couple of days ago. This feels like a solid long-term play, even with short-term earnings volatility. You're right, Ethan. The long-term drivers for MU, especially with AI, are compelling. The company has robust revenue growth at 56.7% and a healthy net profit margin of 28%. And yes, the insider buying is significant at over 28% net shares purchased. However, we need to acknowledge the current valuation. The stock is trading near its 52-week high, and the PE ratio is 40.47. That indicates that a lot of those positive future expectations are already baked into the current price. While the long-term outlook is bullish, the upcoming earnings report on the 18th introduces considerable short-term volatility risk. An earnings report that merely meets expectations rather than significantly beating them could trigger a sell the news event.
So the potential is there, but the timing is everything, especially with that run-up.
Exactly. For MU, our AI-generated insights suggest it's a cautious buy. The long-term fundamentals and strategic positioning for AI are strong, making it an interesting candidate for long-term investors, perhaps on any dips. However, short-term traders should approach with caution due to the high current valuation and the inherent volatility around the upcoming earnings report.
All right, Brooke, let's bring it all together for our listeners. Here's our compiled list of candidates from today's AI-generated insights. Investigate as buy. None. Investigate as cautious buy. Micron Technology, MU. Investigate as speculative gamble. Hims and Hers Health, HIMS.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
That's all the time we have for today, hunters. Thanks for tuning in to the Daily Hunt for Multibaggers. We'll be back tomorrow with more AI-generated market commentary. Until then, happy hunting.